Welcome to Epic Stock Due Diligence. Please subscribe at youtube.com/EpicStockDD. Thank you.
Another exciting episode of Epic Stock Due Diligence, youtube.com/EpicStockDD. Now, what I want to talk about today is a tactic that a lot of traders use. Now, these are traders that are, for whatever reason, financially successful. Maybe they've had a lot of successful plays in the past. Maybe they're just naturally wealthy. Whatever the case may be, they've got a significant dollar amount to speculate with. Now, what a lot of these people will do is that they'll find stocks, typically in the 000 range, sub-penny range. They'll find stocks that don't really have any, they don't have any negative, or they have a limited, if they have any negative exposure linked to them, is probably somewhat limited. And the share structure of these plays is probably very good. Share structure, you could check out my other video, basically at a high level, the analogy of throwing a rock into a bathtub versus throwing a rock into an ocean. When you've got a stock that's diluted, it's like the ocean. Very few, if any, people will notice the ripple when that rock goes in the water. Throw that same rock in a bathtub, everyone's going to notice because it's good share structure. That rock and that small body of water really makes ripple that's noticeable. So what these people are looking for, they're looking for those plays, and probably plays that, even though they have that good share structure and they don't have anything, if anything at all, negative spinning around them, they look for those plays because those plays are opportunities to front load. Now, front load, if you've checked out my other videos how a pump and dump works, front loading is simply the act of a trader, and it doesn't necessarily have to be unethical, but it's just getting in before the noise. Now, if they created the noise themselves to try to pump it, then they become a pumper. But if someone says, okay, there's a penny stock, it's priced at 0008, and the share structure is amazing. It hasn't seen volume in a few months. It's just sitting there. But, I want to put I put some money in there. So they put a significant amount of money. And keep in mind, for a play with a price per share that small, a few $1,000s is really going to rock the socks off of that. So typically what will happen is that one trader will put that money in that play that's, at least at this point in time, silent from a volume perspective. Hasn't seen any buying and or selling recently. The volume is pretty much flatline. And then all of a sudden, you've got 50 million, maybe a few 100 million shares that are traded of that security. It's going to alert a lot of people when they're scanning the stock market, when they're scanning, and you can check out how to screen for stocks, a video where I did that. So it's going to pop up on a lot of people's radar. Now, most often what will happen with a play like this is that person that front loaded before the and ultimately they created a lot of the noise themselves, because when they did that big buy, when they bought 50, 100 million shares, whatever, when they did that big buy for a stock that's been dead for a long time, it's perceived by people screening that stock woke up. So then you're going to see probably the pumpers come in. They're going to say, oh, this volume was because, check out this press release from a week, from 6 months ago where they said they're going to do this and this, that, and the other. And that's where the pumpers come into play and really try to craft a story to encourage others to buy in. And typically people bite. If the share structure is good and everything at least appears to be on the up and up, typically people bite and start following with those buys. So that person that got in initially with no noise at all and got in big, as this stock continues to appreciate, then what they can do is exit. And they can exit for a very, very nice gain, and that's typically what happens. So a person that was front loaded, maybe let's just say they just triple their money. So they've hit the point of appreciation where they're able to triple their money rather, and they put in put in that limit sell order and it fills completely, boom. That is a boom. I mean, they just got rid of a ton of shares. And then you're probably going to see the stock start to correct a little bit as a result of that huge sell that the person that was front-loaded did. And then you're probably going to see a rebound after that. So a lot of smart speculative money. And again, with penny stocks, expect to lose 100% of everything invested. And that's typically what happens. And I'm posting this for entertainment purposes only. It should not be considered a recommendation to buy or sell a security. That's the same with all my videos. But typically what that smart money speculator would do, excuse me, is that they would then, when the stock bottomed out because of them letting go, they would then buy in a little bit, not a lot, but a little bit after it starts to go back up, just to kind of wait out and see, is this going to continue to go back up? Because people will see that dip, that big dip when they exited. A lot of people will see it as a buying opportunity to get in cheap. So a lot of people will buy. So if it continues to go back up, smart money that originally front-loaded on that will likely get back in after it proves it's probably going to go back up. They'll get back in again and ride it up again. And now you're looking at another huge gain, potentially another huge gain. Again, expect to lose it all. But this just illustrates, when you're looking at these sub-pennies that have a few hundred, a few thousand% run, and then they dip a few hundred or a few thousand%, and then they run a few hundred and maybe even 1,000% again. These are typically the types of things that are happening behind the scenes. And not always, but this is just a good way to better understand how these markets work. I mean, again, these are not your big board stocks. These aren't your Amex. These aren't your NASDAQ. These aren't your New York Stock Exchange. These are pink sheets. And if they're really good, maybe they're an OTCQB. I mean, they're junk for the most part. They're junk. But with that said, penny stocks are not about, I met with my financial advisor today and I came to a well-informed investment decision. These aren't those kind of stocks. These are hey man, I talked to this dude in the subway and he's like, yo man, got to get that stock. You can go to the moon. These are those kind of sketchy plays. And it's all about percentage increase or percentage loss that dictate the performance of a penny stock. And again, as always, expect to lose it all, but just kind of try to understand, visualize how all of this works. Because by visualizing how these microcaps typically trade and what triggers the volume and what triggers the lack of volume, it's better. It enables one to better understand the market. And by better understanding the market, one is able to make better educated speculative trades. So, hope you enjoyed this video. Subscribe if you haven't already. It's youtube.com/EpicStockDD. Check out my book if you want to. I got a picture on, go to youtube.com/EpicStockDD. It says buy my book. Got a picture of me in front of the Bull on Broadway in Manhattan. You'll see that little link down there. Feel free to check it out if you want to. If you don't, that's fine. Join us on Facebook. Join us on Pinterest. Join us on Google+. We're out on all the social media. And most importantly, share this video and any of my videos with others. Y'all have a good day.